Other than your general criteria for investing in any company, what are your criteria for investing in banks? And has your general view toward investing in banks changed over time? Second question would be, in terms of a discount rate, do you feel it's appropriate to use your cost of capital or the current risk-free rate? And then in the past, you've mentioned that you do some sort of pseudo bond arbitrage, and would you please specify what types of trades you do in this area?
Oh, you'd like our buys and sells for Monday morning? We're not going to talk about specific strategies that we obviously think they're profitable, or we wouldn't be doing them, and we think other people might copy them if we talked about them. So, and we have pointed out, incidentally, and we will continue to point it out, that there's not a long life to these bond strategies necessarily. That doesn't mean we might not re-employ them when circumstances called for it later on, but they're not like earning money out of See's candy or out of Fruit of the Loom or something. They're opportunistic situations that we're pretty well positioned to engage in at certain times. The question about banking, banking, if you can just stay away from following the fads and really making a lot of bad loans, banking has been a remarkably good business in this country, and certainly ever since World War II. It's the returns on equity for banks that have stayed out of trouble has really been terrific. And there are certain banks, I should say, in this country that are quite large that are earning maybe 20% on tangible equity. And when you think you're dealing in a commodity like money, that's fairly surprising to me. So I would say that I guess I've been surprised by the degree to which margins in banking have not been competed away in something as fundamental as money. How about you, Charlie?
Well, what you're saying in fair implication is that we sort of screwed up the predictions, because banking was a way better business than we figured out in advance. We actually made quite a few billions of dollars really out of banking, and more in American Express. But basically that was while we were misappraising it. We did not figure it was going to be as good as it actually turned out to be. And my only prediction is that we'll continue to make failures like that.
It's fairly extraordinary in a world of, particularly a world of low interest rates, that you'd find financial institutions that basically doing pretty much the same thing, where A competes with B and B competes with C, without great competitive advantage, and having them all earn really high returns on tangible capital. Now, part of it is that they have pushed the loan to capital ratios higher than 30 or 40 years ago, but that nevertheless they earn high rates of returns. They earn much higher rates of returns on assets alone, and then they have greater leverage of assets to capital, so that produces returns on capital that really are pretty extraordinary. And certain banks get into trouble because they make big mistakes in lending, but it's not required of you in that business to get into trouble. I mean, if you keep your head about you, it can be a pretty good business. The question about a discount rate, when you talk about our cost of capital, that's worth bringing up, because Charlie and I don't have the faintest idea what our cost of capital is at Berkshire, and we think the whole concept is a little crazy, frankly. But it's something that's taught in the business schools, and you have to be able to answer the questions or you don't get out of business school. But we have a very simple arrangement in terms of what we do with money, and we look for the most intelligent thing we can find to do if we've got money around, or if we don't buy and sell businesses this way, but in terms of securities, we would if we find something that's at 50% of value and we own something else at 90% of value, we might very well move from one to another. We will do the most intelligent thing we can with the capital we have, and So we measure alternatives against each other, and we measure alternatives against dividends, and we measure alternatives against repurchase of shares. But I have never seen a cost of capital calculation that made sense to me. How about you, Charlie?
Never. And this is a very interesting thing that's happened. If you take the most powerful freshman text in economics, which is by Mankiw of Harvard, and he says on practically the first page that intelligent people make their decisions based on opportunity cost. In other words, it's your alternatives that are competing for the use of your time or money that matter in judging whether you take action or not. And of course, those vary greatly from time to time and from company to company. And we tend to make all of our financial decisions based on our opportunity cost, just as like they teach in freshman economics.
Yeah.
And the rest of the world has gone off on some crazy kick where they can create a standard formula, and that's cost. They even get a cost of equity capital for some business that's old and filthy rich. It's a perfectly amazing mental malfunction.